Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce mediation and valuation services in St. Louis, Missouri. Today, we'll discuss valuations for financial reporting with Mark Zyla. Mark is a valuation expert in Georgia, the managing director of Zyla Valuation Advisors, which is an Atlanta valuation and litigation consulting firm. Mark is also the chairman of the Standards Review Board for the International Valuation Standards Council. He also was the primary author of the education program of the AICPA and the Royal Institute of Chartered Surveyors for the Certified in Entity and Intangible Asset credential. This is the CEIV, which I believe most valuation professionals are aware of, that goes towards certifying valuation experts in valuation for financial reporting purposes. And it's a fairly new credential. Now, a lot of times when people are talking about financial reporting, and we know that, there are specific terms that we talk about in the profession, but a lot of times people get a little confused. So I'll get a startup company or somebody newer, and they'll be like, oh, I need a valuation, or I need financial reporting, or I need this. But then they say a 409A valuation because I'm dealing with compensate, what is that this, are they talking the right language, or what are they really looking for in that space?
Sure. So in addition to just business combinations and identifying assets for financial reporting, there may be other reasons for fair value measurement of assets for other purposes under the accounting standards that impact financial reporting. One is valuation of stock that's issued as compensation, or equity interests that are issued in compensation. So there's a tax reason for that to be valued. There's also financial reporting reasons for those to be valued. So there are valuation techniques that early stage companies who issue, say they issue options to employees, or they issue stock to a vendor in lieu of cash consideration. Under the accounting rules, they need to measure that at fair value and place that also, and that flows through the income statement. So rather than cash compensation, it's the equity compensation.
So like if I'm a consultant and a startup contacts me, and we're going to assume I'm not doing valuations, right? Because that's a little bit of a different issue. But and I maybe I'm a doctor and I sit on the executive board, right? Then the startup company could say, well, we don't have a lot of cash, we don't have a lot of money, but we're going to give you stock. And so I think that most of the time we think, oh, okay, just give them some stock. Who cares? But that's when it triggers the 409A to say, okay, well, what was the value of that stock in lieu of compensation, right?
That's right. And so for 409A purposes, they have to measure the fair market value of that consideration. And then for compensation, and for financial reporting purposes under ASC 718, they have to measure it at fair value. And that goes through the income statement. And those are really important because if a company, for example, is either acquired or eventually wants to exit through a public offering or through an acquisition by a SPAC, the regulators are going to look closely at that because they want it to be at fair value. So they don't want you under reporting that compensation. So they're going to look at how you actually measured that value and look at it pretty closely.
And these are, most valuations that we do are complex valuations, but the calculations within these types of reports, I feel like has a lot more assumptions involved and time and research and things like that. Would you agree that these are a little bit, like you have traditional valuations and then you have kind of financial reporting valuations? Do you agree that the complexity is pretty significantly different?
It is, particularly in a sense that, as I've mentioned, best practices have developed over the last 20 plus years, that because it's for financial reporting purposes, that it's often used as audit evidence for what is being placed on the financial statements. So if it's used as audit evidence, then the auditors look at it closely And so therefore the valuation of the work has to be auditable. So the outside party has to understand why it was done, the assumptions that were used in the process. Typically the process involves the auditor brings on a valuation specialist as part of the audit team. Mm-hmm. So there's some checks and balances and questions going back and forth between the valuation, the auditor, the audit partner, the client, and their outside valuation expert, just to make sure everybody's comfortable that it got to the right answer.